Hello, my dear students. How are you? You have taken so many examinations. Every one of you wants to get very good marks. Every one of you wants to stand first, but only one will stand first. Others will be number 2, number 3, number 4. Now, if a student gets 90 marks, a student gets 90 marks, I repeat. Is he getting good marks? Do you think 90 marks are very good? Yes. Yes, I think you think the 90 marks are very good. But if these 90 marks are good, 90 marks out of 100 is fine, but out of 1000, now 90 marks out of 1000 is nothing. Similarly, if a business earns a profit of 5 lakhs, very good profit, very good profit. But if the business earns 5 lakhs with a sale of 20 crores, with a sale of 20 crores, revenue of 20 crores, 5 lakh profit is nothing. And with a sale of, say, 1 crore, sale of 1 crore, profit of 5 lakh is fine. So what I mean is, whenever we talk of one figure, 90 marks, good or bad, no, you can't decide. You can compare two students. One gets 90, the other one gets 92. Yes, it is 90 and 92. The one with 92 marks is better than the other. So therefore, if there is only one figure, this is absolute. This is an absolute figure. We want a comparative figure. We want a relative figure which will give us the truth. And when I am talking of two figures, I am talking of a topic in your course, that is ratios. This is a topic in your course, ratios. In book 2, and book 2 carries 20 marks, and ratios are there for you to get marks. Now, what is a ratio? A ratio is a mathematical relationship between two figures. It is a mathematical relationship between two figures, not one. Figures must be two. And moreover, when we have these two figures from business statements, financial statements, these are called financial ratios. They are called business ratios. If there is a ratio between boys and girls, well, this is not a financial ratio. In a classroom, there is a ratio of 3:2 between boys and girls. This is not a financial ratio because boys and girls, they don't have anything to do with business. So ratio between profit and sale, yes. Profit is a financial figure, very important figure, and the objective of the business is to earn profit. So therefore, a relationship can be there between profit and revenue, profit and sale. Capital, yes. Amount invested in the business, capital employed, and profit, capital employed, and sales. Yes, these are financial figures, and any relationship between these two figures will be a financial ratio, will be an accounting ratio, will be a business ratio. You may call it by any name. And these ratios help us to decide whether the business is doing fine, whether the business in the on the growth path, or it is going down the hill. So efforts can be made, actions can be taken by the management to set the things right if they are going astray. Therefore, my dear students, these ratios in your course, we have profitability ratios. In these ratios, one element is profit. These ratios, one element is profit. For example, gross profit, gross profit ratio. It is the ratio between gross profit and net sales. Net profit ratio. This one is gross profit ratio. This is net profit ratio. See the two figures, net profit and net sale. Net profit or net revenue. Gross profit or net revenue. These are two financial ratios of profitability. There are others also. ROI. ROI is return on investment, return on capital employed. And the two figures here are profit before interest and tax. Profit before interest and tax upon capital employed. How much capital has been invested and what is the profit? This will give you profit. So we have two more profitability ratios. One is operating expense ratio and the other is operating profit ratio. Operating expense ratio is the ratio between operating expenses and net sale. Again, two figures of financial nature, a ratio between two, that in order to earn this much of sale, how much operating expenses were incurred. And the last one is in profitability ratios. The last one is operating profit. This is operating profit upon net sales. Operating profit upon net sales. Now, what is operating profit? Operating profit does not include any non-operating income. If there is an income from lottery, income from lottery is not the income from the business, it has to be excluded. And whatever will be left will be operating profit and the ratio between the two. So these five ratios are in your course: gross profit ratio, net profit ratio, return on investment, and then operating expense ratio and operating profit ratio. These ratios will give you an indication about which path the business is going. Is it on the right path, progress, growth, or the other way around? So therefore, that was one ratio. Then the other ratios, liquidity ratios. Liquidity ratios are two. One is current ratio. Second is quick ratio. Current ratio is the ratio between current assets and current liabilities. Current assets and current liabilities. These are my payables, current payables to be paid within a year, and these are my current assets. It must be more than one, and the normal is that they must be double. So therefore, current ratio, current assets must be more than current liabilities, meaning thereby that we have sufficient current assets with which we can pay our current liabilities. And current assets will include stock also, inventory also, and prepaid expenses also. Current assets. But when we come to quick ratio, this ratio is between quick assets and current liabilities. Now, quick assets, which are quickly realizable into cash. Stock, whatever stock we have, it is lying in our godown. It will become cash when it goes to the customers. When the customers buy it, it can be converted into cash or debtors, and then it can be recovered. So this is not a quick asset. Similarly, prepaid insurance, it will never come back. You can't realize it in cash. So out of current assets, if we exclude these two, stock and prepaid, prepaid expenses, if we exclude these two out of current assets, we have quick assets. So quick assets upon current liability, this is a quick ratio, and it is also called acid test ratio because it is readily available cash. So when our current liabilities, mean creditors and bills payable, short-term loan, these people have an eye on the quick assets, they get confidence that our money is safe, we can get back our money anytime. So these are two ratios which we cover under liquidity. Another important is which one you must prepare for analysis purpose. Very important and very interesting ratios. They are activity ratios, or they are also called turnover. And my dear student, do you know what is my term meant by turnover? Turnover is another word used for revenues, for sale. It's a technical term generally used for sale in our business transactions. So we have under this ratio, one is stock turnover ratio. I use this stock turnover ratio. Second is receivables turnover ratio. And third one is working capital. Stock turnover ratio, receivables turnover ratio, working capital turnover ratio, and then payables turnover ratio. These four are in your course. They are turnover ratios in the sense that first one is stock turnover ratio. It is the ratio between the value of the stock in hand, and the cost of goods sold. What is the cost of goods sold and what is the average stock that you have in hand? So this ratio is calculated COGS upon average stock. COGS and average stock. And average stock is opening stock plus closing stock, दोनों को जोड़कर divide by 2, this is average stock. Opening stock, closing stock divided by 2, the average stock. And cost of goods sold, what is cost of goods sold? COGS is opening stock plus purchases plus direct expenses minus closing stock. Opening stock plus purchases plus direct expenses minus closing stock. This will be our cost of goods sold. So when you compare these two financial figures, COGS and average stock, it tells you what is the position. Is the ratio higher or lower? If the denominator is higher, average stock is higher, it will be very less. This ratio will be small. If the average stock is very small as compared to cost of goods sold, the ratio will be high. What does it mean? Look here, my dear students. A big stock in hand is not the indication of progress. Stock lying with me is useless. It should be with my customers. If there are two dealers, two businessmen, one has 20,000 worth of stock, the other has 2 lakhs worth of stock, I think the one who has 20,000 is better because his stock is lying with the customers. He has sold. The other one who has 2 lakhs, it's not being sold. It's not selling. So therefore, a higher stock turnover ratio will be better. Similarly, we come to the next one, receivables. Receivables are our debtors. And this ratio is calculated by net credit sales, because this is the credit sale figure which creates debtors. When we sell goods on credit, we have debtors. So, divided by average debtors. Average debtors, once again, are opening debtors plus closing debtors divided by 2. Debtors also include bills receivables, opening bills receivables and closing bills receivables. So together we call them receivables. So it is net credit sale, numerator, divided by average debtors. This will give you debtors turnover ratio. Again, having a big figure of debtors as denominator is not good. If you have large amount in with debtors, that means your debtors are not paying the money. If the debtors are increasing, no good. The less the amount of debtors, the better it is. Debtors, fine, but the debtors are paying the money to you and you are receiving it, they are being reduced. So when we have less debtors, our ratio will be higher. If we have more debtors, the ratio will be less. So it's also debtors turnover ratio should also be increasing more and more and more. Then we come to working capital. Now, working capital is that capital which is used in day-to-day activities. And it comes from, a major part of it comes from long-term sources. But some money is also coming from short-term. But the best part comes from long-term. Now, this working capital is used for day-to-day activities. What are day-to-day activities? Day-to-day activities are making purchases, paying wages, paying salaries, paying telephone bills, paying stationery bills. These are the daily expenses which are incurred, and they are incurred out of working capital. Now, this also is calculated, this ratio, net sales upon working capital, and working capital is calculated like current assets minus current liabilities. Current assets minus current liabilities. That is working capital. So this also says that working capital is used to generate sales. If you use more working capital in order to generate a sale of 1 crore, on the other hand, to generate a sale of 1 crore, you use less working capital. That means the firm which is using less working capital to generate the sale of 1 crore is better than the one who is using more working capital to generate the same. Therefore, this also here the working capital, net sale, this ratio must be increasing. The higher the better. So therefore, we say stock turnover, the higher the better. Receivables turnover, the higher the better. Working capital turnover, the higher the better. So this is how these ratios work. Then we have the last one, that is payables turnover. This payables turnover ratio is calculated with the net credit purchases. Credit purchases, because when you purchase goods on credit, you have your current liabilities, creditors. So it is net credit purchases upon average creditors, average payables. Average payables are the same way, the opening payables and closing payables, both totaled divided by 2, that's the average payables. Now these are the activity ratios. They indicate how much activity is going on in the business. Stock turnover ratio, higher the better. Receivables, the higher the better. Working capital, the higher the better. Credit sales, if payables are more, if average payables, creditors are more, that means you are not paying the creditors properly. Your creditors are accumulating. On the other hand, if some person has less creditors, that means he is very particular in paying the creditors. He promises to pay after 2 weeks, he pays before 2 weeks. That is why his creditors are less. The one whose creditors are less is better than one who have large number of creditors. It's not a good thing that your creditors are not asking for money from you and you become lethargic and lazy, don't pay them. That's no good. Again, we must have a goodwill in the market which is built up by making payment to the creditors in time. So this is something about few ratios which I could discuss with you, that is regarding liquidity, profitability and activity. There is one more, that is solvency ratio, that we will discuss sometime next. So this much is enough, and you must have followed the importance of these ratios, how important they are for the analysis purpose. Thank you very much, my dear students. Nice of you.